we allege that Apple has employed a strategy that relies on exclusionary, anti-competitive conduct that hurts both consumers and developers. For consumers, that has meant fewer choices, higher prices and fees, lower quality smartphones, apps, and accessories, and less innovation from Apple and its competitors. For developers, that has meant being forced to play by rules that insulate Apple from competition. And as outlined in our complaint, we allege that Apple has consolidated its monopoly power not by making its own products better, but by making other products worse.
Coming up today, stocks hit new highs, Switzerland cuts rates, Reddit shares start trading, Justice Department sues Apple, Russia strikes back, gold hits all-time highs, Jerry Jones bets on natural gas, and New Zealand enters a recession. Well, another day, another new high in the stock market. Got the S&P 500 ripping up above 5250 today, finishing the day slightly higher. With this parabolic uptrend continuing to strengthen now, you can see the S&P 500 starting to get back into overbought territory here. And apart from the growth versus value spread, all other risk-on assets are in uptrend mode. Volatility downtrending, with it briefly getting below 12.5 today on the VIX index, showing that there's next to no fear in this stock market. And just looking at the winning sectors today, home builders ripping up 2.4%, semiconductors, regionals, clean energy, loving the prospect of lower yields, and a bit of a pullback today in gold miners, utilities, and a few other defensive sectors. We had another nice move up in the cannabis ETF today, up 8.3% on good volume. Things are looking technically really good there. We also saw Reddit come onto the market for the first time. There's its first daily candle. IPO was priced at $39 a share. However, got a little meme mania early on in the session. We ripped up $57.80 a share on a pretty heavy day of trading, clocking in 48 million shares traded. However, I'll come back to that one and the other most important news story of today. Apple taking a bit of a haircut, finishing down 4% on heavy volume after the government's coming after them. We also saw a new AI stock come onto the market today, Astera Labs. And stick with me, I'll get all into this stuff and a lot more later on. First, let's just look at some news, research, and data from today. So the bulls are still excited from a dovish J. Powell. He is backstopping this stock market, happy to let it run loose, and what's appearing to be more comfortable with higher and more sticky embedded inflation than normal. And that's why we got some bulls like Fundstrap's Tom Lee saying small cap stocks are poised to be among the biggest beneficiaries of Fed rate cuts, still calling for them to rise by more than 50% just this year. And after that latest Fed meeting, they have bumped up a lot more than their large cap peers. And Tom Lee, who has been on a roll these last couple of years, guess it's a lot easier when you're a perma bull, did make a good point when it comes to small cap companies, and as my regular viewers know, it's an area of the market I've been leaning more towards as well due to valuations. And as Tom Lee pointed out, while the Russell as a whole trades at more than 22 times expected 24 earnings, that number is skewed by the share of unprofitable or barely profitable companies in the index. Small cap companies that are profitable are valued at 11 times earnings. That's a bargain compared with the S&P 500 multiple of 21. Last time we saw that big gap was back in 99, and that was right before small caps, along with value stocks and commodity stocks, went on to a huge 12-year stretch of outperformance. Over large caps, tech, growth kind of all rotates in cycles over time. And there's a look at the monthly chart of the S&P 500, which is ripping up into new blue sky territory. However, just got the Russell 2000, breaking out of an 18-month long consolidation, still a bit off all-time highs from November 21. And going down the food chain even lower to micro caps, they too are shaping up, breaking out for a long period of consolidation and basing. And technically speaking, we could be going into that stage 2 of the 4-stage cycle, and that's advancing after we've been in stage 1 basing, accumulating, and typically stage 2 is the best spot to be. It's where the most amount of money is made before we go into that inevitable stage 3 distribution and stage 4 decline. And so this bull market's definitely broadening and accelerating in the winning sectors. There's the monthly chart of industrials ripping up to new all-time highs. Same deal with home builders. Semi's looking a little stretched there on the monthly, pulling back a bit this month compared to these other leading sectors. There's financials just breaking out to all-time highs, but what's really been trading well this month especially is energy. Still a bit off those all-time highs way back in July 14. And what's just a few ticks away from breaking out to new all-time highs, not a lot of people are talking about, is the materials sector. It too having a good March, up over 5% so far. Whereas the defensive utility sector, still pretty weak. One could argue we're still in a downtrend. It hasn't broken out yet. So this is very much a bull market led by growth sectors and stocks. However, what we've got changing now, like I show you with materials and energy, is commodity stocks are starting to come back. And one area of interest having a really good month, agricultural commodities and stocks, with the ETF DBA up almost 8% month to date. And just looking under the hood at wheat and corn, there's orange juice, sugar and soybeans. Agricultural commodities could have a lot further to go if all these important components start ripping up as well. But the best performer so far this year, cocoa. Be prepared to pay a lot more for your chocolate Easter eggs. This stuff isn't cheap at the moment. This is on the back of El Nino weather hitting the big cocoa producing countries. We're just getting back to the bull market in stocks. It's been led for a while now by semiconductors, with the third most biggest company in the world, NVDA, currently trading at a 2.3 trillion market cap, finishing higher again today. And I'd say it's very likely we come up and test this big sell candle here that we got earlier this month after they had a really good AI conference revealing their new Blackwell chip. And that's why we've got some analysts saying things like NVIDIA's heading for a 10 trillion market cap on the back of the new AI economy, which is estimated to add 15 trillion to GDP. And on top of the AI boom, there's a strong macro indicator of a more dovish Jay Powell. And like this article says here, it's like the Fed was data dependent until the data no longer supported its story, with the building view that the central bank isn't as wedded to its 2% inflation target as they previously thought, with top economist Mohamed Al-Aran saying we may look back on this week as the week that central banks stepped away from a very strict inflation target to a much broader concept. And so there's conflicting signals out there with what we're seeing in inflation data, commodities, government spending, but what the Fed and Jay Powell is hinting at what they want to do. And we can see that in the 2-year treasury bonds, kind of stuck in a range now, going sideways, has no momentum, trading at 464. Same deal with the 10-year, sitting there at 426, whilst we've got high yield bonds pressing up against a resistance zone and confirming the risk on mode this market is in. We just heard from the Bank of England, which kept rates on hold as expected. However, Switzerland went against expectations and actually cut their rates, the first major developed central bank to do so. And there's the latest look at global central banks around their world, what their rates are, their consumer price index inflation, what the real rate is, that's the overnight rate minus inflation, the trend in CPI, and what the last move was, a hike or a cut. So you can pause your video player if you want to have a further look at that. However, keep in mind, inflation over in Switzerland is a lot lower than most other Western countries, with their latest year-over-year reading at 1.2%. And just going out to a long-term 10-year chart, you can see they never went as high as the States, UK, Australia, New Zealand, Canada. And so they've kept inflation pretty tame this whole time anyway. And I'd say they're trying to get out in front of other Western countries and kind of lower the Swiss franc, make their exports a bit more attractive, get a head start. And we can see that in the dollar franc today, having a pretty strong move up after the market wasn't really expecting that. And the dollar strengthened across the board, with dollar index now back above 103. So as much as Jay Powell would like to go ahead and do the same thing, we've got the world's second largest asset manager, Vanguard, saying they don't believe the Fed's going to cut rates this year, really going against the narrative and what the central bank is actually saying themselves. But like I've been saying, there's political considerations here as well, regardless of what's actually going on in the economy. So unless we get some really hot CPI prints, say Jay's just going to go ahead and cut in June anyway. And he'll use some clever language and wording to justify it. And let's hope he's not wrong in doing that, like he was with his big inflation is transitory call back in 2022, when it turned out to be anything but transitory. And so him and his 700 PhD economists don't always get it right in their forecasts. And not only will he be doing a solid for the Biden administration, he'll also be helping out a lot of corporate borrowers, commercial real estate sector, and especially the US Treasury, with their interest expense on US public debt in the biggest bull market of them all, with US taxpayers now footing a bill of over $1 trillion per year just to service the cost of their debt. And that is growing by the day. And so I bet Jay Powell is just praying we don't see any more hot CPI prints, so he can go ahead and help out his political masters and kick the can down the road. Moving on from bonds and rates, back to the stock market. And you know it's a bull market when you're seeing a rush of unprofitable companies filing initial public offers coming onto the market. And we just saw that with social media network Reddit trading for the first time today, initially selling their shares for $34. But like I just showed you, we got up to $58. The revenue did increase 20% over the last year to $804 million. Even though the site's 20 years old, still lost $90 million last year. They still haven't figured out how to make a profit, even with 73 million daily average users, and they're just hosting text pages. They're not hosting videos or pictures. It's kind of mind-blowing that they can't make a profit yet. But I guess when you're paying insiders hundreds of millions of dollars, that's pretty hard to leave anything left over for shareholders. Have a business profit and stock market performance can be two different things. Right now, the market doesn't really care. Looks like there was a heap of buying right off the open and that's likely index funds and ETFs, probably a few meme traders as well. But the world we live in now is dominated by big passive index funds. BlackRock, Vanguard, State Street, and regardless of profit or anything, they just buy according to market size. And currently Reddit's valued about $9 billion, more than 10 times sales. And like I said, they'll just buy at any price, it doesn't matter. Not only that, the whole system's game to inflate assets as much as possible. And even though the Reddit CEO got a $193 million compensation package last year, inside the IPO prospectus, there's another award. He'll receive stock more than $22 million at the IPO price if Reddit stock maintains a $5 billion market cap, which is only half what it's reportedly valued at privately less than 3 years ago. So if meme traders can keep the stock bid, then the CEO will be able to continue milking it for more of his own personal gain. And so good luck to anyone who wants to buy that stock. I certainly won't be buying any, regardless if it runs or not. Very well could hit $100 a share. But as an investor, could be a very long time before you see your money back on that. Also coming to the market today is latest AI stock, Astera Labs. Had a really good day, popping up 46% above its IPO price, $36 a share. And this company makes semiconductor-based connectivity products, which are used to build cloud and AI infrastructure. Its major customers include NVDA, AMD, Intel, who are also an investor in the company. They too are losing money, $26 million last year, on revenue of $115 million. And that too has already got a market cap under $100 billion. That's approaching price to sales of 100 times. And there's a look at the 5-minute chart of the first day of trading. Huge amount of volatility, hitting $80 a share right in the nose before finishing at 64. In other words, this is a good time to be an unprofitable company with an exciting story coming to market. And the Reddit CFO will even tell you that himself. Said its company got a good window for its IPO. And so no doubt it's good for the insiders. Let's just see if it's going to be good for the investors risking their money by buying these shares and propping up these valuations. That is still yet to be seen. And Reddit investors should hope it doesn't go the way of Snap, still trading 50% below its IPO price 7 years ago, while insiders have taken out billions of dollars from the company in that time, with them selling millions of dollars of shares almost on a weekly basis and doing zero buying at all. And so today I wanted to introduce you to my latest custom indicator for TradingView. However, you could think of it more like a trading tool compared to a traditional indicator. And the word indicator often gets a bad rap because there's a lot of clowns in my industry that try to market indicators with 90% win rate, make $1 million overnight, all that ridiculous stuff. However, in today's day and age, TradingView now allows developers like me to code up some really cool stuff, new ways to visualize the market, and now even visualize your portfolio. So with this new trading tool, I've named my portfolio monitor. You can add it to your chart. You just come and add up to 35 symbols, the amount of shares or ETFs you bought, your average price, and then it'll do the rest. So here by example, I've got my top 10 picks I gave out the start of this year on the Click Capital YouTube channel. We can see overall not doing too bad, up 4.7% so far this year, with the cannabis one out the front up 39%. You can also see a daily percentage change, the weight of each position in the portfolio, and other cool things like where each position is relative to its RSI and whether it's above or below the 150-day moving average, both of which you can configure those settings. And so it's just an easy way to get a bird's eye view at your current portfolio and where all the individual positions are. And if you run multiple portfolios like me, you can add the indicator as many times to your chart as you want. Then you just come up here and you can toggle it on and off by hiding it. And then you can show another portfolio that you may be following. And this updates in real time. So you can see exactly how your portfolios are performing and where each position is technically speaking. And so like I said, anybody who's purchased all my custom indicators for TradingView always gets free access to all indicators I develop in the future. So for all you guys, please allow another 24 hours for these new indicators to be added to your account. And then when they are, you just come up to indicators, scroll down to invite only, and you'll see them all there and you can add them to your chart. And for your convenience, if you want to copy my custom chart layouts in TradingView for market analysis, sector analysis, technical analysis, fundamental analysis, and tracking your portfolio, then head on over to my website, clickcapital.io, go to the indicators page, then scroll down right to the bottom of the page to the frequently asked questions, and you'll see links for each of my 5 chart layouts, and you can just click on them and it automatically loads all my indicators, and then you can just save it inside your account. You don't have to set it all up yourself. And if you don't already have my custom indicators, stay tuned because next week I'm going to do a special offering a big discount to get all 25 of them for a lower price than the normal fee of $397. Plus there'll be an option to get my online course as well, in which I share all of my trading and investing strategies, along with how to best use my indicators. Moving on to one of the biggest stories today, Justice Department suing Apple, alleging a legal iPhone monopoly, reminiscent of the antitrust case against Microsoft back in 2000, which some people say marked the top of the NASDAQ tech bubble back then. And so Apple's woes just continue. Market's already been bit soft to them, having flatlining growth for a couple of years, don't really have an exciting AI product. They had to pull out of the Apple car. They had to partner with Google to try and get in on the AI boom. They got negative growth in China, not to mention the China risk. Now today they've got a big battle. Attorney generals from 15 states, including Apple's home state of California, joined the lawsuit, filed in federal court in New Jersey. The lawsuit asserts that Apple has engaged in behavior that not only limited competition in the smartphone market, but also affected a variety of other industries that rely on mobile devices to reach consumers, including financial services, fitness, gaming, social media, news, and entertainment. US Attorney General Merrick Garland said that Apple controls more than 70% of the premium US smartphone market, charging as much as $1,600 for an iPhone. Apple has maintained monopoly power in the smartphone market, not simply by staying ahead of the competition on the merits, but by violating federal antitrust law. Pretty strong accusations. Going to be interesting to see how this unfolds. No doubt they're a monopoly. That's why Buffett invested in them. He loves what he calls pricing power, aka monopolies. And Apple's been accused by many of these monopolistic practices, not just the government, but others in the industry, especially with their 30% commission they take from the App Store on developers, which a lot of people call an internet tax, stifles innovation, competition. This is also on top of the European Union earlier this month fining Apple nearly $2 billion for favouring its own music service over rivals such as Spotify. Justice Department's also coming after Apple's partner Alphabet. Pretty much all these big tech companies run monopolies. That's how they got so big. And this was similar to the big Microsoft case, launched in 2000, accusing Microsoft operating monopoly in the web browser market for Windows, kind of in the same way how Apple controls the hardware operating system and then what runs on top of it. You could kind of think of the hardware like land, and whatever happens above the land is controlled by the landowner. That's why we got Zuckerberg really trying to push his Quest VR headset and worried about Vision Pro taking hold, because he knows if Vision Pro becomes a dominant headset, he'll have to play by Apple's rules. But anyway, the judge actually ruled Microsoft had to be split up into two companies, one for its operating system, one for all its software. However, that was appealed and overturned in 2002. So it was kind of messy, dragged on. There was no really clear winning side. However, what's interesting, just looking back at Microsoft shares in that period of time, kind of eerily similar to Apple. After a huge 90s, they ripped up. They kind of started stalling out a bit and lagging the overall market in 99, and this is when the DOJ first came after them. And then it was on this week here, April 2000, that the judge ruled against them, said they had to split up, and it kind of just fell into a big downtrend after that. Even though they successfully appealed and won, you have to go out to a monthly chart to see how long it took Microsoft to come back to those highs. It wasn't actually until 2017, it's almost 17 years later, it took them to take out those new highs again, even though Microsoft was still a really dominant, profitable cash cow of a business this whole time. And so here we are today on Apple. Had a great run up over the last 10 years. We've stalled out. Now the government's coming after them. I'd be very surprised, even if the market continues to run, if we saw Apple take out these highs above $200 a share anytime soon. And a whole sea of investors who've known nothing but Apple just going up and up. It's a great company. We all love their products. We all know them. We all know they're going to be around forever, going to be a cash cow business for many more years. However, like I just showed you, that was the same deal on Microsoft back in 2000. And if Apple were to repeat the same pattern, going to 17 years before it takes out new highs, that's 2041. And what could look something like the same as Microsoft. And that's going to take a lot of patience for anyone invested in it, if that were to happen. And unfortunately, a lot of people who have over-concentrated their portfolios into Apple, as they've been conditioned so long to believe it's an eternal winner, may have to find out the hard way that even big profitable stocks can have long, prolonged drawdown for many, many years. And just moving on to cryptos and commodities, still got Bitcoin having a little bit of a pullback ahead of the halving event, when pretty much the new daily supply of new Bitcoins being mined gets cut in half from around 900 a day currently to around 450 new Bitcoins a day. And what's really been helping Bitcoin rip is all these new ETFs have on average been buying a couple of thousand new Bitcoins per day, a lot more than the current supply. And amazingly, the new Bitcoin ETFs, which are only a little over 2 months old since they first started trading on the market back on Jan 11, already have more assets under management than the largest gold ETF, GLD, with them currently having 60 billion assets under management. And there's a look at the daily price of Bitcoin, just holding ground above 65,000. However, on the monthly chart, who knows, it still could be a triple top. Market seems convinced we're going to 100,000, which very well could happen. Don't ever underestimate the stupidity of crowds, especially when there's money involved. And I'd say if we did go above 100,000, it would likely draw more of the government's attention, and they might really start getting worried about the threat to the US dollar that Bitcoin is. And at that stage, they may just expedite the central bank digital currency, CBDC, which they're currently just looking into now, researching. And this is a trend around the world. central bank digital currencies. And so what they're likely to do is develop something that has all the benefits of Bitcoin: fast transaction times, digital wallets, no need for physical currency. However, it's likely to be a lot more secure than Bitcoin. For example, with Bitcoin, if you have it in cold storage and you lose your 12-word password for whatever reason, your Bitcoin's gone. If someone hacks into your account, steals your Bitcoin, it's gone. Whereas in the current financial banking system, the government will backstop you, or your local bank can insure you. And I know a lot of people are paranoid about the government and the bank having control over the money. However, I for one like being backstopped by my government and bank, just the same as I like owning assets that trade on regulated exchanges, something cryptocurrency does not. So it's the real wild west of digital currency. It'll be interesting to see how Bitcoin's valuation holds up when the government releases its own digital coin, which I would say is pretty much inevitable, and even more so if Bitcoin keeps ripping. Just moving on to oil. Actually saw that pull back a little bit today on the back of more contraction and manufacturing activities in the largest crude importing regions in the world, the Eurozone, led by Germany and France. And the market didn't really seem to mind Russian President Putin ordering a fresh bombing of Kiev and Ukraine in a likely response to them coming after their oil assets, sending a bunch of new age hypersonic missiles their ways, of which many were shot down. And this is the first attack on the Ukrainian capital in 6 weeks. And even though they managed to shoot them down, the debris falling from the sky unfortunately still caused a lot of damage and some injuries. However, it looks like they managed to avoid fatalities. However, this is likely not the end of it. If it was deemed an unsuccessful attack, they'll probably have another go at it. And even though oil didn't react, nor could stocks care less, maybe that's why we've seen bit more of a flight to safety to gold, getting above 2,200 an ounce for the first time ever. And this is on top of a more dovish J Powell, which is a good thing for gold as well. And there we are on the daily chart, gold futures pulling back after getting above 2,200. However, it's looking a lot more constructive on the monthly chart, breaking out of this years-long pennant formation. See if we can hold here going into next month. Also got Dallas Cowboys owner Jerry Jones slapping a cool 100 milli in a natural gas company, Comstock Resources, out of Frisco, Texas, and not a huge company either, 2.3 billion market cap. And so maybe Jerry thinks natural gas is cheap here, which it is near multi-decade lows. Just zooming out to a monthly chart, it's only been down at these levels a handful of times looking back in history. So I'd say he's right, and that there's way more upside than there is downside. And just looking at the curve structure of natural gas futures, they're actually priced in more closer to $4, in which this commodity is priced in 1 million thermal units, which is about enough to heat a home for about a couple of days. So pretty cheap stuff, $1.69. Heat your home for a couple of days, well off those 2022 highs of $10. And so you may not know, but I bring you these daily reviews from where I'm based in Queenstown, New Zealand, which is a small town, relatively speaking. About a permanent population of 30,000 people. Very big tourist town. We get about 2 million tourist visitors a year. We're known for outdoor activities, skiing, golfing, boating, fishing, hunting, hiking, biking, and we're also known for our quality wines. Be sure to check out some Central Otago Pinot Noirs if you're into wine. And so Queenstown's near the bottom of the South Island, New Zealand, and the South Island doesn't even have 1 million people in it. New Zealand as a whole, 5 million. And apart from tourism, our big exports, agriculture, we sell a lot of milk, dairy, which the wealthy Chinese love to buy, not to mention livestock and other farming products. And our economy just technically went back into a recession for the second time in as many years, after our fourth quarter GDP contracted 0.7%. And so, of course, we're a tiny country, tiny economy, less than 1% of the world's market cap, really no global influence. Typically in the long run, we had a saying here, when the US sneezes, the world catches a cold. And so we've got the UK, Japan, a few other countries, and us as well, in technical recessions. However, the US has been the real standout. I'd say a big part of that is to do with AI. We don't really have any dominant tech companies here. We kind of all use the US apps, not to mention a lot of us invest in the US as well. So it's just an interesting trend in the world. And you could kind of think of it, maybe if the US didn't have this AI boom, they would have went into a recession like the rest of the world is pretty much done. And so maybe the US has skipped this recession, because the way it looks now, it doesn't look like the US is going to catch up with the rest of the world, especially if rates are going to get cut. That should just stimulate the economy and the stock market even further. However, if demand across the rest of the world continues to stay weak, that could spill over to the States later on this year. And just moving on to some economic data we got today. There's jobless claims pretty much coming in line as expected. Composite PMI better than expected, along with manufacturing back to growth in the States, and a big bump up in existing home sales, 9.5% month over month. There's a look at Fed Fund futures, still given a 70% chance the Fed's going to cut in June. Got the greed index at 75, and corporate insider activity dropping off a bit, both in buying and selling yesterday. And we've gone way into overtime, so thanks very much for sticking with me, and make sure you come back to the channel tomorrow I'm going to share with you a few interesting spread trades that have been doing well for me lately and why I think they have further room to run. That's all for today. I'll see you again tomorrow night. Cheers.